Hello, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president. And it's my pleasure to have you join us both in person and globally on the web for the latest of our Macro Week events. Today, we are delighted to host the Reserve Bank of New Zealand Governor Adrian Orr, who will be speaking on monetary policy during periods of economic volatility. As some of you have been following have heard me say, the focus this fall of the Institute, not entire, but primary agenda beyond the election, is to think about what can third nations, important like-minded economies, and importance is not just size, do in a constructive way to manage the spillovers from China-US conflict, particularly in the macro sphere, and to have a positive agenda in the trade and commercial sphere. Because whatever the result of the US election, sadly, but realistically, we cannot expect the China-US economic conflict to go away, and we cannot expect China or the US to be terribly constructive in these areas. But there are other economies, other governments, other central banks that are trying to be constructive, both in the sense of setting examples for others in how to navigate this situation, and in terms of working with others in an open way to maintain a somewhat rules-based, somewhat open, and still globalized world economy. Adrian Orr is, I think, at the forefront of this in multiple counts. Both Governor Orr and the Reserve Bank of New Zealand are punching above their weight in the Anglophone sense, which in my case, or Adrian's, takes a bit of doing. Adrian is a very well-humored person as well, which is why I can say that most central bank governors won't take that sort of thing. But joking aside, I and many others in the monetary policy community admire Adrian for his leadership, intellectual and principled. Adrian has been in a number of increasingly senior roles in New Zealand and globally. He was first appointed as governor of the RBNZ in March of 2018 and was just reappointed for a second 5-year term starting a year ago, March. So he is moving up in the seniority ranks. After education abroad, he joined the Reserve Bank in 1989. And then after a few years worked at the OECD for 3 years, and then returned to New Zealand, and after a brief stint as chief analyst at the Treasury, he returned to the RBNZ as chief economist. And this was, of course, the period of the Reserve Bank of New Zealand being one of the early adopters and pioneers of inflation targeting. He was appointed chief manager of the economics team of the Reserve Bank in 1997. He spent some time in the private sector between 2000 and 2003 as chief economist for Westpac Banking Corporation, then went back to the bank for 4 years as deputy governor and head of financial stability. And from 2007 until his appointment as governor in March of 2018, Adrian was the chief executive officer of the Guardians of the New Zealand Superannuation Fund. For those of you who are not in this business, that may sound like a Marvel superhero movie, Guardians of the Superannuation, but it's actually very cool. It is effectively the overseer of the sovereign wealth fund and the pension funds in New Zealand. During his leadership, the superannuation fund did some breakthroughs in organization, in transparency, and in principles that, among others, our colleague Ted Truman has written about in the context of sovereign wealth funds. But we turn to him today for guidance for his central bank and other central banks in navigating the period of economic volatility which we all face. Thank you for joining us today, Governor Orr.
Well, thank you very much for that beautiful introduction. It's always terrifying hearing your own CV read out. It sounds like someone who can't hold a job down, really. It used to be every 3 years, which was the horizon of our forecasting abilities, so you probably get the idea. And Ted, wonderful to see you, sir. Many decades pioneering on the transparency and purposes of sovereign wealth funds, and a real guiding hand, particularly during the International Forum of Sovereign Wealth Funds birth and ongoing. Today, I am being beamed back to Aotearoa, New Zealand. We chose to put this speech on the record, in part in recognition, Adam, of your excellent institute. So it really is a privilege and an honour to be speaking somewhere so prestigious. It will be a little unusual because I'm going to read some of it, and I know that Kathleen would be thinking you've never seen me read anything before in life there, but I'll do it. Now, I just want to say, I've got Rebecca here, Rebecca Williams, who heads up our forecast, so any mistakes are hers. We're very good at blame storming, aren't we? Is that, but we've both travelled a very, very long way to be here. We've come from afar, a place called New Zealand, or Aotearoa. The name that the very brave Polynesian navigators, their descendants eventually gave to New Zealand, Aotearoa. They were incredibly brave navigators. They arrived in New Zealand between 1200, 1300 AD, and our ancestors right up to this day tell a very interesting story, which I am going to labour throughout this speech because I think it will help me, but help a lot of people listening to just understand the challenge and uncertainty of monetary policy and, in fact, decision-making in any level. So our ancestors, they travelled across the South Pacific to make Aotearoa their home. Kupe was the name of the famous navigator who left in his vessel, his waka, with some well-trained and courageous people, with only a vague idea of where the island of Hawaii, where they were starting from, was, an approximation, and certainly no real sense of how far the destination was, just a true belief that there was a destination out there. It was well beyond the horizon, of course. The time of arriving was going to be unknown. The storms were unknowable. What were they going to run into? And the strength of the vessel and the courage of the crew, they were going to have to box smart, sail smart, and to keep going all the way through that. I would say that the most important thing to the success of the journey was the crew must have had an incredible faith and belief in this island existing somewhere out there over the horizon. And the crew must have had an equally strong faith in the navigator, because mutinies are probably more common than not. We call that in monetary policy inflation expectations getting away on us. But, to have that faith in the navigator and belief in the target that is over the horizon is really important. You're probably catching on to the story as I go. I do believe that the premise of the navigator really does hit home for most leaders across any industry and activity, and very much for monetary policy. We are navigating sometimes through the calm, but most often through the storm. We have only an approximation of where we might be starting from in our economies. We're always trying to work out how the vessel operates. We have no idea what the next storm is. We're constantly looking for charts and signals that we're on course, and we're continuously updating that course on the way through. So it's been really nice to be here in Washington, the IMF and World Bank, and it is certainly a race of the meetings, but we get to chat to people who are all experiencing the same challenges. Many of them are perennial, new means of assessing where we currently are in our economic position, better means of forecasting ahead, providing ideas where we're going. I would like to say more improved strategies in managing uncertainty. I think they're the same strategies across the groups, but we all use them in slightly different mixtures at different times around talking about the uncertainty and, most importantly, communicating with confidence, particularly during stormy times and very unpleasant times. If the navigator is starting to get a bit shaky around where they're going and what they're meant to do, well, very quickly you're not going to have many people in your vessel. They will be looking for something else. So what I was most pleased to hear of, and it has been a long time, monetary policy decision makers have largely succeeded over the last couple of years. We can talk about whether they could have succeeded easier or done better in the past and so on and so forth, but they retained their clear goals. What were we trying to achieve, which is primarily low and stable inflation when it comes to monetary policy. A few wobbles in there, you know, some people said, oh, 1 to 3%, which is our inflation target, that's feeling a bit hard. Why don't we just make it 5 to 7, because we're currently in that. You know, the navigator can change many things, but they can't change the location of the island that they're trying to sail towards. So you know, a little bit of happiness. In doing this, I feel very wired up here. It's, retaining confidence right through all of this was the hardest and most critical thing to be doing, because whatever we do today, it's 1 to 2 years ahead before we see, or at least 2, before we see the full impact on inflation of our activities. So in other words, our goal is always over the horizon, and that is embedded in our monetary policy remit in New Zealand. We are tasked with targeting future inflation over the medium term. So it is embedded that we need to have our head up, looking over the horizon and doing our best. The good news is, because of the global efforts and smart people like Adam and many people in the room at this institution, we've been able to rely on robust monetary policy tools, decision-making frameworks, and we've stood on years and years of research and effort, and we're surrounded by very smart people who are dedicated to the task of helping us navigate through these periods. And I think, you know, why is it so important to have strong and credible institutions and tools and independence to get on with the navigation? Because it's necessary. Our clarity of purpose, tools, capabilities makes the task simple, but not easy. And it's the easy reverse the hard part I now want to chat about a little bit. And Adam, I think we're going to be sitting and chatting. We can get to China, etc., in good terms. But first of all, you know, central banks, we dedicate significant resources to trying to understand both where are we now and what might possibly happen in the future, and what that means for things that we care about: output, inflation, employment. Significant efforts, and even then we're just surrounded by nothing other than uncertainty that is almost impossible to articulate mathematically. We have many attempts at doing that. This term radical uncertainty has popped up because just good old uncertainty wasn't radical enough. So there we go, radical uncertainty. And we have seen this across everything that we've been doing in monetary policy globally and in New Zealand over recent times. First up, volatility in the data. Volatility, that's another way of saying missed forecasts. Our communication challenges, just incredibly difficult to keep the crew calm. We're in high waters, we'll reset the bearings. Ebbs and flows in inflation expectations, and dramatically changing price behaviours. So I can't think of a thing that we couldn't have thrown at us there. So that's the first part around the data. The next part is around, you know, what really is the starting point, and I'll go back to like Coupe, the navigator. You know, they had to piece together a view of where they may possibly be starting from in the ocean. Stars, clouds, wavelengths, returning birds, whales migrating. You know, we have been working in a very similar type of data world. I would say Coupe had one major advantage. When the whales went past, it was real time. We have to wait 3 months to be told a whale went past. So in our data. So statisticians have faced ridiculous measurement challenges over the last few years since the pandemic. Historical relationships have broken down. Seasonal patterns have shifted. In the online version of this, we show you some exciting dramatic graphs of just how cross-eyed the data has become. And the data has kind of reverted backwards and forwards depending on whatever the social mobility restrictions were in place at any time. In New Zealand, and I know Rebecca here in the audience with me, you've had to grow your hair back several times because you keep pulling it out every time we get new consumer spending data. It's when you can't survey, you can't get the data. And I know it's not unique to New Zealand. I was just with the Bank of England folk talking about their labour market data or lack thereof it. I think they're down to surveying only 20% of the population or something. This is, you know, just fundamental basic stories are broken down. Of course, every data, even when you get hold of it, is going to have its strengths and its weaknesses. One was that lag I talked about. So we have to look and cast our net as wide as possible and draw on lots of more higher frequency, timely data. I've never come across a business yet who have told me that their data is exactly the leading indicator we need for the economy. From the taxi driver through to the local corner shop, through to the owner of the transport company and so on. You know, we are constantly pulling together higher frequency data, surveys of households, businesses, traffic information, energy consumption, tax data, financial market data, all of these sources. And now, of course, if you're a modern board member, they would say, are you using AI? Somehow that's meant to solve it. So, you know, information that's timelier also has its shortcomings, and we have been suffering through these shortcomings. You know, high frequency data can have signal and it can have noise. And when you're in periods of heightened volatility, that noise has real consequences. I do, one of my favourite navigating lessons I received from reading about coupe was, and all Polynesian navigators will know, if you follow an ocean-going bird, eventually it will land back on land. But the trick is to follow it in the evening when it's going home. So I think we've followed a few birds that were on their way out rather than their way home. Second, once we've got this kind of a possible concept of where we're standing in the state of the economy, our starting point, we then need to fundamentally review everything around how we think our economy works. And that has been a challenge. You know, New Zealand, Aotearoa, it's a small economy. It's 5 million people. It's the rest of the world is isolated from us, and it gets buffeted by just about anything you could possibly think of. Global economic swings and roundabouts, travel, exports, capital flows, trade relationships, climate conditions, and global investor sentiment. When you're a small economy and you are less than half of 1% of a global index, and then it comes risk-off time globally because someone's done something, well, we're gone, we're out. It's not like they've downsized us, they're out. And so, you know, these global sentiment challenges are really critical for us. We have to be better than better and transparent because, you know, we are a highly traded economy. Whilst, you know, decisions by foreign central banks are really necessary and important to us, they are far from sufficient. You know, when you're in a small open economy, and I know that a colleague from Sweden, you know this, you know, to have your own monetary system, a floating exchange rate, sorry about that, and operational independence of a central bank just becomes an absolute core necessity to path economic well-being. Some of the economic relationships that we've been challenged with, I would say, first and foremost, was what happened simultaneously globally when the COVID-19 pandemic was arriving and then had arrived. It arrived in New Zealand quite late. We got to watch, we got very scared, as everyone else did, but we were alive and trying to work out the preparations and what we should do. The only people who complain about everything that went on around the COVID lockdown these days are the ones who are still alive. So I think we should remember that. So the disruptions were, you know, just phenomenal. We, and I'll talk a little bit about what we did around our monetary policy, but first, the suite of interventions that happened globally, simultaneously, yet all independently driven, in one part excluding the US, which will be a really interesting research part, around providing cyclical support, fiscal support directly to the households, directly to the businesses to keep the labour forces together, was already post the beginning of our easing cycle. So to suddenly be part of this, simultaneously monetary doing its usual work, here we go, not too sure, and then these global fiscal policies, you know, just even understanding that simple, that part was, you know, incredibly novel and presented real challenges. In New Zealand, you could not be an economist without mentioning the Phillips curve. I'll let other people explain that. The relationship between capacity and inflation, that changed in our framework. It steepened right up, small changes in output, big changes in inflation, and we were, you know, really our core around how we were projecting was struggling. And of course, consumers and investors' preferences changed depending on where they're allowed to go, whether they're allowed to walk around outside or travel offshore, and we've seen that globally. Services overtook goods, and then goods overtook services around what we were doing. That was exciting. We broadly knew where we were. We broadly knew that our model wasn't really working that well. And then, of course, we had to change policy instruments. Many countries were already sailing in extremely shallow waters. You know, the effective lower bound became a new acronym, ELB. We went too far off it. In fact, I think November 2019 was, we were busy wisely talking about how we're getting prepared to be able to use additional monetary policy tools. It's much easier to talk about when you actually believe you're probably never going to have to, so we were very bold. And by February, we were into it. Now, you know, quantitative monetary tools are very old, but they hadn't been used for a few hundred years. So very recent, and the experience had been, you know, still being debated and argued. Temper tantrums and so on and so forth. In New Zealand, we had never used it. So we had to very quickly have a strong sense around what works, what doesn't. Fortunately, we were able to observe. We didn't have to be leaders. We were fast followers. And we decided it was necessary, given the dark hole we were staring into, particularly around financial stability, to be basically taking a risk management approach to where we were going. We believed that the worst thing we could do initially was to do too little too late and find ourselves in a financial system that had imploded. I can talk about the sensitivities. So that was, you know, a lot of fun. And when we were trying to communicate our new tool, you know, years and years of having weaned people onto this official cash rate and then saying, no, it doesn't really matter, it's this one. How's that one work? Not too sure yet. We'll tell you as we go. You know, that is, and when your core job is to communicate confidently that you're still looking at the island whilst you're changing sails and, in fact, putting outriggers on, was quite a challenge. And then, of course, and finally, if the violin isn't too loud yet around how hard we've had it, you know, we could observe in real time the growing threat of COVID-19. No one knew how long it was going to last. No one knew if we were going to have vaccines, et cetera, et cetera. But the other part no one knew was what other shocks may come along with us. So there was a period where I've never seen such, what's the experiment? You know, tossing a coin, heads, tails, heads, tails. And we tossed about 10 tails in a row of supply-side shocks all going in one direction. And, you know, all central banks were just continuously getting caught out with just a bit more, and we can see the closer to the Baltic states you were, the more extreme it was around some of those price pressures. But that shock, how big is it? How long is it going to last? How will it impact? Is it going to be supply, demand, a bit of both? And that, you know, that how long it lasts question, you know, the exciting debate between transitory or permanent, you know, or persistent. So we've had to grapple and work our way through all of this, but we're here because navigating monetary policy is more like circumnavigating around the globe rather than match racing in a yacht. We don't have to be that worried that someone tacks to the left or tacks to the right. We're in our vessel, we've got our target, we've got our horizon, and we were able to follow through on that. You know, while the navigator can't change where the island is, we can certainly change our pace and our course. And that was done very often. The very first thing, you know, when you do change your pace or course, given that it's going to be another 2 years by the time you see the outcome of this great decision that the committee's just made, you've got to keep people calm. And so that continuous communications. You know, I think central bankers, shockingly, we do need to improve significantly on the way we communicate, because we will always be in the world of uncertainty. Probably on the global circumnavigation story, you know, I always like to think when we turn up, we create our projections, we put out our single line, our forecast. That's no different to unfolding the map in the yacht there and saying there's the island and drawing a line. But, you know, you don't really know how the vessel's sailing, you don't really know the currents, you don't really know what's going to be the storm next, and so it's almost extremely impossible that will be the line you actually follow until you get to the island. It's a matter of being able to continuously change things. But when something that looks really tough and horrible, you know, a reef turns up somewhere on the horizon, or it becomes probable that you're in the wrong areas, then you do need to make quite dramatic changes to monetary policy. And this is what we had to do during the last 5 years. We had to dramatically shift. Our room for regret was doing too little too late, and we dramatically eased monetary policy very quickly. Were we believing that we were heading to low and stable inflation? Yes, but not directly. The first thing was to stay afloat. We were heading to calmer waters to sit out whatever these storms were. And, you know, rule one, sailing first, stay afloat. And so that's exactly what we had to do. So it's probably more often we always talk about managing monetary policy in a more circumspect manner, you know, finding your way, data-driven policy, you know, being updated regularly. But our risk tools at that time featured really heavy in the Monetary Policy Committee. It was harder stern, and we just wanted to stay afloat. We avoided the worst case scenario, which was that deep, dark recession and a financial system that collapsed. But very soon, our worst case scenario, because things were actually getting better, changed. And that worst case scenario now became high and embedded inflation expectations. And you have to, again, remember where you've come from. When it cleared and the storms came up, you know, the North Star, our neutral interest rate was well above where we currently were. So again, like most central banks, we had to take quite dramatic action just to get back to a neutral. It was really interesting. Markets always think in increments. Oh, but you know, you're at 25 now, you're 50, you're tighter, and you're saying, yes, but the rope is still slack. You know, we were talking a neutral interest rate, some 300 basis points north of where we were at that time. So we've had to get there quick. I put in here, you know, on a personal note, if I podium at the monetary policy statement in New Zealand, I remember it so well because it's such a shock. And I thought if in February 2020 someone offered me 7.3% inflation and 3% unemployment in 2 years' time in an option, would have I bought that? And the answer is absolutely yes. And that's where we ended up. And we ended up there despite having more and more shocks in between. So, you know, whilst we've taken plenty of abuse, I would have bought that back then because it would have meant we're alive, people are employed, and we get to re-stabilise inflation rather than rebuild a financial system. So we've done our tilts, we've headed north, we're back around got above our neutral rate, and you know, the monetary policy mutiny calmed down. People are now starting to again believe in low and stable inflation, we hope, on the way through. communicating through all of this uncertainty. You know, there's lots of ways of doing it. I would say in 2020, we were so humble that we said, we're not going to provide you a projection. We're just going to provide you some scenarios, and we're going to tell you which scenario we may more likely be in as it evolves. And it wasn't for another year before we came out and boldly used the word projection, once we started to have a sense around vaccinations and transport. So that was a really important use. Having a central projection, it's incredibly useful. We have an endogenous interest rate path. Great way to explain where we're going, but it's only one mark on the chart. Unfortunately, of course, provides incredible focus for the financial markets. They then get their slide rules out and work out rates of change in the forward graph, and then tell us we're wrong because they're forward curves. You know, it just tells you nothing about the range of uncertainty. So the scenarios are something we've always been using. We can have, you know, the fan charts around the uncertainty. But we've got a pretty strong belief, one with scenarios. When you put scenarios out, people take that as a policy signal. And it's very hard to articulate that we're just showing you reaction functions. Oh, well, that scenario, but that scenario didn't happen, so you were wrong. And you're thinking, so I'm just trying to get the reaction functions going. And the fan chart world, you know, let's draw the rivers of blood and those sides. Even those create a spurious sense of confidence and accuracy around what you're doing. And as my friend said, once you've seen one, you've seen them all. Where have we got to? As you've we noticed now, storytelling helps so significantly. It is the richest means by which to explain how you've come to a sense of where we're standing, where we think we're going, what our reaction functions might be, and always focused on the horizon that matters for us and our focus on inflation. We have started trying to tell our story well in what's called our record of our meeting. So we publish our forecasts, monetary policy statement every quarter, but the first 3 pages are gripping reading. Cut and thrust of a monetary policy committee at work. You can't buy this stuff. It's fantastic. Ted's already, he's read it. And it is a true source of how we got to the decision we made. What always surprises me with it, though, is the financial market will look at the forecast and then start debating that. I haven't really talked to anyone who's ever actually directly read the monetary policy statement or the record of the meeting. Most people get it secondhand, filtered through a journalist's mindset or a financial analyst's position talking, whichever way it is. Now, that is not to at all blame the readers. It's the communicator's challenge to continue to think, how can we communicate better and better and better in ways that are meaningful to the public, you know, have the perspective, we're going there, have the empathy, I'm talking in your language, I'm trying to understand how it matters to you, but then the courage to make the big calls, because, you know, it's perspective, empathy, courage that builds the trust between us and the public. If trust is only ever going to be on how accurate our most recent forecast was, you're not going to build big trust. It's kind of like back in the, you know, private investment days. If your monthly performance is your only part of your reputation, well, good luck with that. You don't have one. You've got to have other things to build the reputation on. So, you know, I would love people to be reading that. What has been worrying us most recently? A lot of that communication, challenges and how we can articulate. Those were the beautiful words shouted out by Coupe's wife on the boat. And she was saying, a cloud, a long white cloud. Aotearoa, a long white cloud. And that long white cloud meant that they had their island in sight. I'm making the same call now. Aotearoa, we have our island in sight now. Inflation is back in 2.2. The crew and the passengers have calmed down, and we are able to start easing our monetary policy. I say in sight, we're never there yet, because there's still some lingering inflation challenges, no different to the rest of the world. The inflation challenges around the services sector, the homegrown domestic inflation pressures that we've all there. So we've eased policy, but it's still on the restrictive side, and it will remain there through time over coming quarters as we get more and more confident that pricing behaviour has renormalised. We've looked at our pricing as inflation got higher. What did people do? They predicted next inflation by what they currently saw. People got more and more regressive in their inflation, and that means that price setting behaviour, observing prices which are being affected by general inflation, just persist and keep persisting. The good news is some of the work that we've been doing, and I don't know whether we've just got our rose-tinted glasses, is showing that we are able to start bringing our projection. People are adapting quicker as inflation comes down. A lower inflation environment means inflation is less interesting. Price-setting behaviour are adjusting quite quickly, and that is what we're watching. We want to get it back into the rational inattention world, where no one really cares what the central bank is doing or what inflation's just done, because there are more important things to get on and worry about and do our job. So I'll finish up there. I would say you can read a lot more in the speech. It's got some lovely pictures. We're now in a situation where we can credibly provide the perspective of an economy returning to low and stable inflation. Interest rates are becoming less restrictive, and we project that to continue over time. And then I'll always finish with, but this is just the most recent navigational plot on the chart. Thank you very much. Yeah. I hope you enjoyed some sailing.
Yeah, it's a beautiful image for all of us. No, thank you, Governor. You're demonstrated for us all the power of storytelling, and scenarios, as you mentioned, are simply a slightly more quantitative form of storytelling. And just to editorialize for 1 second, when the late Thomas Laubach and I were doing things for the inflation targeting book some 35 years ago, or not 35, 25 years ago, we had this image of what we call disciplined discretion, where the point is not that you meet your target, but that you keep explaining why you're not. And it sounds like you're very much in that mode. So let me pick up from that. How different or not do you think it is for a public in a small open economy to have reasonable expectations for how stable it can be versus, say, a US or a Euro area where they may feel absolutely what happens here, we should be able to control it? Or is that a chimera? Is that something that wouldn't?
I'd probably answer it in a couple of ways and try and be quite quick. So GDP figures, of course, when you aggregate across such a large country like the US, will be quite stable. But that doesn't reflect where you're sitting. Right. There are many different economies here, and you've chosen to have stability in certain things and not others. For a small open economy, it's critical for us, I truly believe, to choose out of the impossible trinity what you want. You can have an inflation rate and the interest rate becomes endogenous, and the exchange rate will go where it wants, or you can try and fix an exchange rate and so on and so forth. So, you can't buy all three. We came from a long history of trying to buy all three, and eventually your economy just comes to a standstill because you've got so many unaffordable false promises. And when those false promises break, you have social cohesion collapse. That's where New Zealand got to in the early 1980s. So, we had a very, very deliberate choice that it's going to be low and stable domestic inflation, which will need a sound and efficient financial system, but it will mean a freely floating exchange rate. And the first, it's kind of like democracy, it's only the first 400 years that it's difficult. It's about the first 15 years in New Zealand of lack of trust in the institutions, that you could even get inflation down. That wasn't unique to our country. But for people on the streets who suddenly had this thing called a moving exchange rate as an export nation. So, you know, there was a few tractors driven up the front steps of our government parliament building and all of the good usual stuff. I have to say, and I'll touch wood, through the entire this period as governor, you know, I had the 3 dibs, chief economist, deputy, through this governor, I don't think I've been asked a single question about the exchange rate.
Really?
Other than by CNBC. So.
And who cares about that?
You know, it's just kind of become, in part because it hasn't been moving a lot, but people are sophisticated now that they know it's, they need to manage that. That's just one of the variables they manage. So,
that's fascinating. And like you said about rational inattention, in the sense it's an analogous thing in the exchange rate sphere. So from the point of view of your analytical team, has that behavioral change changed how exchange rates affect behavior in the New Zealand economy? I mean, is anything evolved in terms of transmission?
I think the risk management of foreign currency exposure is extremely good, world class in New Zealand. You know, we're wonderful at running current account deficits, and the IMF are wonderful at trying to work out why or how they should be worried about that. But they always come out saying, "Oh, okay." You know, we all like it to be smaller, but you know, the foreign direct investments hedged, the banking system's hedged, very sophisticated even at the retail level for major manufacturers, either buying forward or sometimes it's better to be open if you're an importer and so on and so forth. So the, you know, the financial management of it is very sophisticated. In terms of through the economic models and structures, no, it hasn't changed. You know, it's really, it's still the same relative proportion of import-export, the tourism dollars coming through, foreign direct investment. So all the transmission mechanisms are very much the same. It just depends on the volatility that we're going to be experiencing. You know, the central bank, we have a decent chunk of foreign reserves to step in and provide liquidity should, you know, the usual central banking roles be needed. And we have an intervention capability. But I think the eyebrow has been raised on that twice in Reserve Bank history. Maybe 3, you know, that was and that was really more of a, I like to think about it more of a karate move rather than a boxing match. I'm just using their own weight to make them fall over. It's, you know, just entering the market. So the transmission mechanisms are there. One of the nervous things over the last few years is, you know, the good story is when you're in a low and stable inflation, you have a relative price shock, we can look through it. Right. Tell everyone that. But when you're actually in a high inflation and you've got that mutiny kind of being talked about on the vessel, and then you get another relative price shock, it's much harder to say, we'll just look through that. Right. So it was so pleasing the last few quarters where we actually finally had no relative price shocks of massive significance. And that's been a long time, isn't it?
Well, I wanted to ask you about that next. I mean, as you mentioned during your remarks, Governor, you and other central banks, but New Zealand notably, had this series of supply shocks that were both frequent and pretty much all in the same direction. How do you, if we are in a world where supply shocks are going to be more frequent for geopolitical reasons, for climate reasons, for technological reasons, whatever, does that change how you decide what to look through and whatnot? And in particular, if there are, for good reasons, positive shocks to carbon pricing, say, a series of those, should the central banks be looking through that differently than they are other things?
Yeah, so just, you know, very quickly, we're paid to be paranoid. We're a full-service central bank, by the way. We do the prudential regulation as well as the financial stability of the money and the cash and the monetary policy. So, you know, a big part of what we do is write documents about things we should worry about. And the geopolitical tensions, the trade, you know, fractions and size are no good. And, you know, we are now, I think it was 30% trade exposed to China. very direct. Fortunately, it's soft commodities and food security type things. But, you know, New Zealand, are we Asia, are we part of the Five Eyes US, you know, these types of things lead to these geopolitical decisions where we could just say you're out. And so, you know, we have got always, you know, we're well diversified, but we've got a strong dependence on China, even for tourism, not so much for foreign direct investment, but certainly for trade. So, you know, those are real challenges for us. How do we be everyone's friend? We've managed that for quite a long time, probably by just being so ineffectual and out of sight. Most global maps don't have New Zealand on it, so you can get away with quite a lot. You know, increasingly we're being asked to choose which side. So that's a really, really difficult one for us. Across the rest of the resilience side, I would say, you know, the climate change is an existential threat to everyone. And may those carbon prices get some tension on them. At the moment, I'm not sure anyone's even holding the other end of the rope, you know, around the pricing. And I can only say, you know, resilience is this word. Everything we're doing is about how can we increase our resilience. And that's not about, you know, it's not mitigation or avoidance. It's about how can we weather the weather. And that's from our financial resources. We do significant stress testing with all the financial institutions and insurance companies. Governments are very often ones the last, you know, because it's very unpopular politics. Sides there, so working really hard around just raising that resilience. We're part of the global network for greening the financial system, the central banks, and a lot of other work. Everything comes down to capital, operational, legal, reputational resilience that goes on.
But so just to press you for a second, because as you are part of, a lot of central banks are thinking about this. I mean, in terms of monetary policy making, should the central bank be adjusting the definition of its target? Should it be treating expenditures or investments in climate differently beyond the resilience, which you talk about? And if the answer is no, that's fine. But
I think the answer is no. Rebecca, team, you know, we've done a lot of work around the, basically we assume that prices are going to be a lot more variable, but most of it are going to be relative prices. Inflation is aggregate and it's a rate of change. And so, yes, society is going to have to adjust to a lot of different relative prices, and there will be times when we just have to say, that's a one-off relative price. We have to look through that. And, you know, so some businesses will be more expensive to run and some businesses won't exist, but that will be primarily a relative price challenge. Where monetary policy, you know, it's more about the impacts on the supply side of the economy. This time, no, March last year, we had a big region in New Zealand taken out by a terrible cyclone, and production stopped, GDP goes negative, resources go to the region. So it's more around that disturbance rather than a relative price thing.
Thank you, very clear. I'll turn to our in-person audience for on-the-record questions in a moment. There'll be a mic traveling as well as the standing mic in back. But one last one from me, if I may, Governor. Again, going back to some of your themes from your speech, which I'm sure will be widely read even without the pretty pictures. Thinking about scenarios and how central banks communicate. So you mentioned rivers of blood, the fan charts. I was at Bank of England. We all discussed these things. And that was an attempt to say it's not just the straight line, get out your slide rules, as you said, to the financial markets, but it didn't seem to work. After leaving the bank, former Governor Mervyn King, but also more recently, Chairman Nobel laureate superstar Ben Bernanke, in his report for the Bank of England, have talked about trying to shift to scenario planning. Meanwhile, I, among others, have been complaining a bit about the Fed recently, that they seem to be very focused narrowly on a few quick decisions and not setting up scenarios. Anyway, I'm not asking you to evaluate other central banks, but just a little bit more from you on the pros and cons of scenarios. You mentioned that when you've tried to talk about this, some people say, oh, that scenario didn't happen, therefore you were wrong. Is there any room to improve or use more widely scenarios in central bank communication?
I think there is significant ways. And, you know, a central scenario, that's great, it's wonderful. We have the interest rate that's endogenous, so people, you know, inflation always hits 2 at the end of our forecast. The interest rate does the work. Right. And people can see the sense around what the Phillips curve operation is in there. And that's a great core discussion. Then we spend a lot of time saying, but don't follow that. It'll be data dependent, we'll be back soon, so on and so forth. I would never want to walk away from that central projection. I would always want to use, when necessary, and most often outside of a standard monetary policy statement, as many scenarios as you can think of. And that's an education process and a reaction function storytelling. And we do a lot of that through our financial stability report rather than our monetary policy statement, because there, you know, we've taken the banks through hell and back, and we said, go and make yourself broke, now reverse out on how you got there. You know, these types of stress testing, real lies, and that is what creates the richness. The confidence intervals and bands, our models, you know, you know, we've got a general equilibrium model. You can kick it anywhere you like, and it looks as good as gold in 2 days' time. You know, resolves and so your band is, you know, the answer you get from it is how you coded it in the first place. It doesn't. Whilst it makes people think a little bit wider than where it was, it's not telling you a rich economic story. So I've been really, it's early days and I'm busy challenging our economics team. When you're sitting in there the whole time and monetary policy become about who can do the best forecast, and then you come up to the table and you sell the forecast and we argue about, you know, whether that's right. I think you get lost amongst the trees and lose the forest. So that risk management story I talked about was thinking about, in 2 years' time, looking back, where would I least want to be? And how can I make sure that I retain as much optionality as we can? And more of that thinking needs to be done. When I left the central bank and went to run the New Zealand Super Fund, I had to unlearn economics. I had to get away from pretending I could predict what happens next and put my dollar on it. You can't. Instead, there are lots of far more sophisticated risk management tools that can be added. So put the forecasts out, talk about the uncertainties, do the variables, but then leave the room. And then come back a day later and say, well, if that's where we think we're going, where would we not want to be? And how could we make sure that doesn't happen? And you know, it is a very powerful way of freeing the brain up and articulating the story of what you're doing. So incremental in good times, but really think about risk mitigation if something bad is looking really probable.
Thank you very much for that. Let me open it up to our in-person audience. There's a microphone in front. Why don't we start there? Please identify yourself, even if you're world famous.
Thanks, Adam. Thank you for this event. And this is Reza Moghadam. I work for Millennium Capital at the moment, long time at the IMF here in Washington prior to that. First of all, thank you very much.
Sounded like an Alcoholic Anonymous beginning, wasn't it?
Yeah, yeah. No, that kind of advertising.
It's okay.
That's fine.
One day at a time.
But thank you for a very interesting speech. I think you gave us a very good insight into decision making in light of uncertainty. But I think you also were quite humble and humorous. But when you look across the central banks, New Zealand was both fairly fast with a higher speed than most and got to, if you like, to the peak of rates, probably ahead of many. So your strategy was a strategy of speed and force, if you like. And I just wondered, what sort of lesson does that give you? You also articulated that obviously you have reached the peak, that you are looking forward, and the same type of uncertainties, perhaps not as strong, but the same type of uncertainties apply when you are going back to neutral. So what lessons do you have from going up to coming? What does it tell you about coming back down?
So the first thing is I wouldn't want to run monetary policy like that all of the time. You know, this is us about just having a sense of, let's be real around what do we really know at this point? You know, this is a 2020 COVID. And the answer was not a lot, and dark looked really bad or worse in one direction than the other. And so we steered as far away from that, which was the financial system implosion and so on and so forth. We ended up getting more sprinkling from fiscal policy, and there's lots of debates around it could have been 5 instead of 7 and all of that type of stuff, but we were still afloat. Then at that point, at what point do you know, once the skies cleared a little bit, what we had to do was recenter people's expectations, because people were talking about tightening of going from 0.25 to 0.5. They're thinking, oh my God, that's just a slight shade different of still extremely loose. And so reminding people that neutral was way back up there, and we might as well get there quite quickly and then start working from there. So that was really the pace. The first one was about quickly having sufficient liquidity and manage. The second one was about getting back north of neutral, signing that. If you were incremental back to neutral, we'd still be halfway there at the moment, you know, in the traditional way. So just, you know, quickly do it and let people get a handle on it. You know, personally, with the committee, at what point is enough enough? We only went to the vote once during this whole cycle. We have a consensus one, and the vote was, we're at 525, and we went to vote whether we should do one more. So, you know, at that point, that's great, you know, if it's, it means, you know, when you, and what was that great saying? If it's really uncertain what to do next, you're probably in the right place.
Right.
And so that was the highest level of uncertainty. It's exciting debate about one more or not. I don't think it would have made any difference to the outcome, but, you know, it showed that we were tough, convincing. Then patience. So on the way down, you know, we can be more incremental now, and, you know, we have been. We're being more incremental because we're in calmer waters, but also because of that lingering inflation persistence in the domestic side. So we're happy to be less restrictive, but I said it's in sight. We're not saying that we're now in loosening space to do it. So just being a bit more circumspect on the way down relative to how we got there is the general idea. By the way, the markets say, yeah, whatever, Adrian, and they've already priced in, you know, 200, each 300. So, but that's right, that's what makes markets. Yeah.
Terrific. We have one more question right there.
Thank you, Ted Truman, formerly at Peterson, thank you for the shout out now at the Malsavar Romani Center for Business and Government. Mouthful. I did have the privilege of spending a month at New Zealand, but one of the periods when you were not at the central bank. And there are two features of your approach which are still there. One is that you have a range for your target, which is some other central banks, but you're relative. That's and I'd be interested to see how you think that has served yourself during this period. The other feature is that you put out a forecast for the rate, which is now, I guess, more done than was done when you first did it. And you and Adam have been talking about that, and with pluses and I assume minuses, and so there are some minuses. But I'd be interested in thinking about how you described, interestingly, how you, especially on the forecast, why you abandoned it, right? And changing policy or changing approach is very challenging in this environment. There's a tendency we've always done this, so we're going to keep. But I'd be interested in your remarks about how easy it was to move away from that, and then and the merits of the target range.
Yeah, so very quickly, I mean, the answer it was extremely difficult in the communication front. When you were used to providing a projection and people, and then, you know, it says we're going down, you cut the OCR 25 and it's got another 50 basis in the forward path and stuff, and people pretend to be interesting and ask questions. And besides there, when we said we are going to do, you know, the Mario Draghi sense, whatever it takes, and with a new quantitative instrument, we were forced, and unfortunately we avoided it all but one option of, well, how long for, you know, what was it, the two, we had the two Greek names, I forget anyway. We ended up, that's right. We ended up somewhere in ancient Greece, and you know, about not nailing ourselves to a time or a point target, saying we will be working through this over time. A lot of central banks got themselves quite stuck because they wanted to provide sufficient certainty for their actions to happen, and you know, were saying for the next foreseeable future, 2 years, well, it'll be this or it'll be that. So we avoided that, and we gave them scenarios and ideas. If it feels more like we're going down path A, then we might do this. If it's going down path C, then we're going to be doing this. And so that's how we communicated with the public, and then we kept telling them where we thought we were more close to over time until we came back to a central projection. So that was, by the way, the genius of hindsight has just been phenomenal, how everyone else got it exactly right. That was really the best way that we could play it through that period. And around the inflation target band, we take the band seriously. You know, we're not, you know, the best way to stay within a band is, first of all, to aim for the middle. So we're always aiming for the middle of the band. But we're always going to have relative price shocks that are going to be knocking us off left, right and centre. And so, you know, we're not losing particular sleep if it's 2.3 versus 1.7. In fact, I think the Reserve Bank, for the best part of a decade, was below the midpoint quite some time. So,
Thank you all very much. It's been a real privilege as well as an enjoyable learning experience to host Governor Adrian Orr of the Reserve Bank of New Zealand here at the Peterson Institute. I'm sure our virtual audience online is cheering, but those of you with me now, please join me in thanking Governor Orr.